All right, we finally have the Fed clarity we were looking for, and I have to say, while they may have missed the mark previously and caused some of the inflation that has occurred, they are doing what I think is a very responsible job of addressing the problem that has been created, the inflation problem. What did they miss? Well, they certainly let the economic stimulus go on a little too long, and that has certainly led to some pretty elevated inflation, which is now being slightly exacerbated by the Russia-Ukraine conflict. However, their approach to handling that, I think, is quite well calculated. Most importantly, I think balance sheet reductions. They have no need to be a participant in this market. There seems to be excess liquidity and plenty of liquidity to keep markets afloat. That facility is no longer required. With regards to the rate hikes, there seemed to be a little bit of negative market sentiment when it was, we're going to have 7 instead of 6 total rate hikes this year. I think that is a little ridiculous, if you ask me. People were saying 6, factoring in, maybe we'll have some level of economic wobble, and at some point in the next year, the Fed may decide to not hike at a particular meeting. They did not take that off the table. What their approach is that the economy is strong now, and they forecast it to continue to be strong. So if those two situations hold, they will hike at every single meeting. They're going to raise 25 basis points at a gradual pace, assuming all else is going to plan. That is the plan. I think that was understood prior to this meeting, that the Fed would just inch itself at a predictable pace towards normal policy. I don't think there's anything crazy that went on there. Maybe some people were predicting that there was going to be some economic wobble, and that's why it was 6 instead of 7. Well, the Fed will make it 6 if that becomes the case. They didn't commit to 7. They said, Jerome Powell said in his testimony, each meeting is a live meeting, meaning they're not going into every meeting planned to hike rates at that meeting. If the economy is okay, they're going to hike. If there's wobble, they're not going to hike. If inflation keeps piling up, which is not good, we are at a high level of inflation. It's high. It's not catastrophically high yet. It might not be. But if it gets there, then they will pick it up a little bit. If the economy is strong, they will do so. If the economy is not strong, well, it's hard to see how we're going to have inflation, because part of the inflation we have, I'd say most of it, the money supply has increased, but the economy is strong. Maybe the two go together. But if the economy gets weak, like it has in the past, deflation typically occurs. Yes, there is stagflation. But my expectation is, because this is a demand-driven inflationary environment, if there's a recession, there'll be less demand, and that will cause inflation growth to slow and come down. So I think the Fed is taking an appropriate approach here. And as Jerome Powell continued to talk, we saw the market churn to new highs. We saw a dip initially, and then a churn to new highs. I think this is a very good response to the Fed. And some people were, trying to see what the Fed was gonna say. I was here to try and figure out what the Fed was gonna say. My approach now is, I did not get the super bear situation. I did not get a Fed that was, looking forward to 50 basis point hikes. They mentioned it, but only if necessary. Only if things get really bad in the inflation camp will they consider doing that. But they're also not too dovish. They're not letting inflation get out of hand. They're not doing nothing. They're not being, over dovish. Some people, of course, will argue that they are, and some people will argue the opposite side. That's what makes a market. My opinion here is they are doing a responsible thing, and interest rates rising will mean that the level of liquidity, stimulus, people flocking out of bonds because they're not offering a good rate of return, all that is going to approach to a level of normal. So I don't think the trajectory that we've had from the bottom, March 2020, until November 2021 is going to remain. I think we're in a new normal kind of market, a mid-cycle market. We've had an early cycle market with heavy stimulus. That is now in the past. Now we are in a mid-cycle market. It's probably going to be a little more flat. We have geopolitical uncertainties. We have interest rates gradually rising. But none of these things, I think, have the potential to completely tank the market at this point in time. The stocks that were too expensive have tanked. They have taken the hit. That's a good thing. We want to see that. The level of froth, excess, surplus in the market is now relatively low. I'm not going to say it's all gone. There's certainly some still there, but there's also certainly some over pessimism there as well. And I think that's why we saw the bounce yesterday, and we're seeing such an aggressive move today. I'm not saying this is going to hold. I'm not saying this is a trajectory. I'm not saying we're in for a massive recovery to new all-time highs. I think it is a long path to new all-time highs. That is quite a big move. It would require to get to all-time highs, about 10% or so on the S&P and way more on the NASDAQ. So let's not expect we're going straight to all-time highs. But think about it this way. A lot of froth has been taken out of the market. A lot of people have been killed, have been just sell all. There has been a high level of bearishness and expectations for the worst possible outcome. So it's possible that a name you fundamentally like, that you think is a great company, is priced very attractively right now. And if that's the case, I think we're in a very, very solid, I'm not going to say safe, I'm not going to say exciting, but I'm certainly not going to say bearish, because I'm not in that camp yet. State to buy good stocks at good prices and hold them and allow them to grow. This is not an early cycle environment. This is not a stimulative environment. This is not a bounce off a recessionary low environment. Okay? I want to make this clear. I don't want to sound too bullish, but I want to be realistic. And I want to address both sides of the coin right here, because it seems like we're really somewhere in the middle. And sideways market, good prices, should still do well, but don't expect massive, quick returns out of single stock names. Yeah, maybe it'll happen last couple days, it'll happen for a couple days in the future, just so we can, catch up some of the over pessimism, because we're not super bullish, we're not super bearish, we're somewhere in the middle. So maybe we were, as a market, a little too bearish. Maybe now we need to correct a little closer to the middle. Sure, some growth stocks were up 10% today. Maybe they'll be up 10% again tomorrow. Who knows? We'll see. But don't expect another massive growth run to new highs when we hit all-time highs, all-time highs, all-time highs. That is going to take some time. Don't expect a massive NFT bubble. Don't expect the shitcoins to do well. That is early cycle, excess liquidity environment stuff, which is no longer the case, okay? The Fed is now tightening. The Fed is now tightening. I want to reiterate that. However, they're tightening very calmly, very slowly, in a controlled environment. And if things go wrong, they made this very clear. If things go wrong, they will adjust. If they have to adjust, they will. If there is economic wobble, if the economy goes through the first rate hike, which is in, the first rate hike is in, okay? We're now going to see, are things going to change? I mean, I don't know. We had a rate hike today. I'm not panicked. I'm not panicked about 25 basis points. Are you panicked about 25 basis points? I mean, it's not going to affect us at all. Sure, rates are going to tick up a little bit. They've been ticking up, and yes, the market has pulled back. But I think the market has pulled back not because, the Fed didn't do anything. They moved in anticipation of the Fed doing something. So I think that was okay. There was certainly some froth. We had to adjust to a non-quantitative easing environment, but I don't think this is a constricting environment. I think this is we're still in a loose environment, and I don't even want to talk about loose. I would rather not look into the past. I'd rather focus on the fact that it is a tightening environment and say we're entering a normalizing environment. And stocks can do well in a normal environment, but they're not going to have the same kind of tremendous bounce. But it's not tremendous bounce or crash, right? We can do something in the middle. So something in the middle does not mean all stocks do well. There will be stocks that don't do well. Focus on price, focus on opportunities. Some growth might not do well. Focus on good quality growth companies, these things. And you can be okay buying a stock that you have done homework on, that is priced well, etc., 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 and holding over a longer period of time. 10% moves today in some stocks is nice. We had some yesterday. Maybe we'll have some tomorrow, but I do not expect that to continue. So that is today's video. And until next time, peace out.